Traditional finance functions through centralized trust. When you send a payment or buy a stock, you rely on a bank or a brokerage to accurately update a ledger they alone control. This system requires a massive human and institutional infrastructure, clearinghouses and auditors acting as the ultimate gatekeepers of ownership. In 2009, a pseudonymous author named Satoshi Nakamoto introduced Bitcoin. It was designed as a peer-to-peer electronic cash system, a protocol intended to allow individuals to move value directly to one another, without any bank in the middle. The core innovation is the blockchain. Rather than a single master ledger held by one company, the software shatters that central authority. It distributes identical copies of the transaction history across a network of thousands of independent computers, known as nodes. To maintain the ledger without a boss, the network uses a consensus mechanism called proof of work. These independent nodes compete to find a specific numerical solution that validates the next block of transactions. The first node to find the solution earns newly minted coins and transaction fees as a reward for securing the network. As the value of those rewards grew, mining moved from personal laptops to an industrial scale. Today, securing the Bitcoin network requires massive data centers filled with specialized hardware and access to vast amounts of inexpensive electricity. Despite this physical growth, the early ecosystem was defined by the principle of self-custody. Ownership is determined by a private cryptographic key, a secret that authorizes spending. If you don't hold that key yourself, you don't truly own the coins. In the 15 years since its launch, the application of this technology has changed. The same software designed to bypass the banking system is now being integrated into it as the world's largest asset managers begin to accumulate the tokens for their own regulated products. Bitcoin functions effectively as a digital gold, a scarce, decentralized asset. However, its underlying code is intentionally simple and rigid. It cannot easily process complex financial agreements like loans or insurance. Ethereum introduced smart contracts, self-executing programs that automatically carry out agreements once predetermined conditions are met. These formed the basis for decentralized finance, or DeFi, allowing users to lend, borrow, and trade assets through code rather than a traditional bank. To support these complex applications more efficiently, many networks transition to proof of stake. Instead of using computing power, this system uses validators, who lock up their own tokens as collateral, earning rewards for processing transactions while risking their stake if they act dishonestly. By making the blockchain programmable, developers successfully automated the core functions of the financial system. But in doing so, they also recreated the need for the very tools and services provided by traditional finance. For most people, pure decentralized finance is too complex and risky. Managing your own private keys means that if you lose a password or make a single typo during a transfer, your funds are gone forever, with no path for recovery. To solve this, centralized exchanges like Coinbase and Binance emerged as user-friendly bridges. These platforms hold the private keys on behalf of the user, providing a familiar interface that functions essentially like a digital bank account. These platforms generate revenue through trading fees, spreads, and custody fees, the exact profit drivers of legacy Wall Street brokerages. These exchanges also rely heavily on stablecoins backed by traditional cash and U.S. Treasury bills, linking crypto directly to the traditional financial system. To reach a global audience, the industry compromised on its original ideal. To make crypto accessible, it handed control back to large, centralized, profit-seeking corporations. While the blockchain itself remained secure, the market built on top of it was defined by extreme price volatility. Without the stabilization mechanisms of traditional finance, tokens can lose half their value in a matter of days. The software itself carried risks. Vulnerabilities in smart contract code have led to the theft of billions from DeFi platforms. In 2022, the collapse of an unbacked algorithmic stablecoin called Terra USD wiped out tens of billions of dollars in wealth in less than a week. The greatest failures, however, came from the humans running the new centralized platforms. The collapse of the FTX exchange revealed a massive deficit of lost customer funds, proving that even in a trustless system, users were still vulnerable to old-fashioned fraud. The underlying blockchain performed as programmed, but the humans operating the giant exchanges did not. These collapses demonstrated that the ecosystem could not function safely without external oversight and regulation. Regulators began a global crackdown. In the United States, the SEC moved to enforce registration and disclosure requirements on crypto offerings, while tax authorities and money laundering investigators increased their scrutiny of every major exchange. To survive this new environment, the crypto industry pivoted. Instead of trying to disrupt the financial establishment, firms began seeking partnerships with the world's largest asset managers and banks to gain institutional legitimacy. This pivot culminated in the approval of spot Bitcoin and Ethereum ETFs. These regulated investment vehicles allow pension funds and retail investors to gain exposure to crypto prices through the traditional stock market, without ever holding the digital assets themselves. Simultaneously, traditional banks began tokenizing their own assets. They are now using blockchain rails to represent government bonds and real estate as digital tokens, aiming to settle transactions faster than their own legacy systems allow. Stablecoins have also evolved into a legitimate settlement layer. Major payment processors now use them for cross-border remittances, moving billions of dollars around the world using the efficiency of the blockchain while operating within standard banking rules. The era of crypto as a decentralized rebellion has largely ended. By trading its independence for mainstream capital and regulatory clarity, the digital asset industry and the traditional financial system have simply merged into one.